Hello everyone, my name is John Locke. I'd like to welcome you to the winning trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we are showing hypothetical computer simulated trades and the results. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with lockeinyoursuccess.com. That's L-O-C-K-E inyoursuccess.com. And myself and my team are here to help you win in the markets and in life as well. And today I'm here to take you into the realm of what we call high probability options trading. Now, high probability options trading, also known as income trading or positive theta trading, is where we utilize options strategies to make money through the passage of time rather than depending on price movement alone in order to make money. Meaning we can often make money whether the market goes up, down, or sideways. Now, this doesn't mean we're going to make money all the time, but it does mean we have a much higher probability of winning than we would if we were purely going directional. The strategy I'd like to demonstrate with you today is called the bearish butterfly. Now, the bearish butterfly is a strategy I developed quite some time ago, and we've been trading this in the live markets for many, many years. The strategy is traded on the Russell 2000 index, and it takes advantage of a variety of market conditions, such as overextended uptrending markets, volatile and very volatile sideways markets, as well as volatile downtrending markets, and smooth downtrending markets. The strategy requires a minimum of $5,000 per trade. The example size we're going to be covering today is substantially larger than that. It's going to be a $50,000 planned capital trade, and the position is going to have what we call a high profit target of $15,000, and that's going to be 30% of our planned capital. And if we happen to have a trade that we're having a little bit of a hard time on, and we happen to get what we call 21 days to expiration with the strategy, we're going to reduce our profit target to 10% or $5,000. Our exit loss trigger for the trade is going to be our 30% number or $15,000. So it's a substantial size. If you plan to use this strategy on your own, please make sure you size it appropriately. All right, let's get into the trade. So what I'm showing you here is a software called OptionNet Explorer, and this is an analytical software, and I'll just quickly describe what's going on here. So we have our date here, and we are in what we call back tester mode, and we went back to April 23rd, 2021. And if you take a look at here, these are the options cycles that are available to us from a monthly standpoint. The top are our call options, the bottoms are put options, and these are our strikes. And this tells us the mid price, the implied volatility, the delta of each of the options, and then we have what our position is here. This option expiration cycle is June 18th, 2021. We are now 56 days to expiration. And this side here, we have a graphic example of what our position looks like. So across the bottom, we actually have the price of the asset, or in this case, the Russell 2000. And up the right side here, we have our profit and loss numbers. If we take a look at this, this shows a little bit more or a lot more than a normal price chart. It's actually three-dimensional. So in other words, we have what we call our expiration line, which is the dark blue colored line. It looks like a triangle here. And this gives us the value of the position, or the profit and loss in the position to be more accurate, at any given price point of the Russell 2000 at expiration. So if the Russell 2000 were to go down to 2150 and we were to let this expire, then we would be experiencing a loss of a little less than $5,000. It also means we have a little bit less than $5,000 in the trade at this time on entry. If I go here to what our short strikes would be, which is 2260, then if we were to let this expire and we're at 2260, we'd be up almost to $45,000. So that's basically what that means. And then we have our T+0 line as it's called, and this shows us the estimated value of our position as of today at any given price point in the index. So this is telling us if the index goes down to 2150 today, then we would be up $955. And if it were to go up to, say, 2400 today, we'd be drawn down about $2100. Okay, and over time, this T plus 0 line will take the shape of our expiration line. Now, if we were to just sit in this position, you can say, well, we don't have a real high probability of winning because the index actually has to be between 2210 and about 2305. That's 100 points. That's not bad, right? But if we were to leave it alone, that would be the case, but that's not the case here. What we're going to do is we're going to make adjustments. And this strategy, let's take a look at the entry first. We enter when we're 56 days to expiration. There's no technical analysis involved, although you could utilize technical analysis and market conditions to improve your win rate and to improve your returns on the strategy. The way we're demonstrating it today is completely non-subjective, so we did not take a look at the charts. We did not take a look at implied volatility. What we did is we simply entered in this case, what we call our first tranche, and in this case it's 10 butterflies. And what we do is for our short strikes, or the strikes that we're selling, we're going to go about 20 points below the money. So here you have the asset is at 2280.88. Approximately 20 points under that is 2260. We're going to sell our 2260s, in this case 10 calls and 10 puts. And we're going to use what we call 50-point wings. We're going to go 50 points up from there. And we're going to buy our 2310s. And we're going to go 50 points down, and we're going to buy our 2210s. This creates a position called an iron butterfly. Now, when we execute this position, we would do it as one order. We would come in and we put in an order for an iron butterfly, and we would work that order and eventually get filled on it. And we would be in a position that graphically looks like this. And from a strike standpoint, this is where our strikes are. Okay, so from here, with this strategy, we have what's called a scale-in strategy. So as the market rises, or as the market goes up, we're going to make our position bigger. We're going to increase it in size to a point. Okay, so in this case here, we have 2260 short strikes. The asset price is at 2280. If the asset price gets to 2300, we're going to add in another butterfly, and we're going to do it here at 2280. Then if it happens to go up to 2320, we're going to add in yet another butterfly, or a third tranche into our position, and we'll have butterflies at 2260, 2280, and 2300. If the asset continues to go up, then we're going to start a rolling procedure. We go as far as 3 butterflies and we stop. We don't want to get any bigger than that. And then we start rolling. So we would take off this 2260 butterfly, we would bring it up higher, and so forth as the asset price goes up, to try and keep up with in an attempt to keep up with the asset price with our position. And if the asset goes the other way, we generally do nothing. There are conditions where we would roll this back, but in this particular case, we would need a very large asset move to the downside, probably under, let's see, 2100, to even consider starting to roll this back. Until then, if we're in this range here, we're generally going to keep the position where it is. So this is how we start. Again, it's April 23rd, 2021. Asset price is at 2280. Let's move ahead. So after 3 days, 3 trading days, it's the 28th of April, and you can see the asset price is over our 2300 add point. This being the case, what we're going to do is we're going to add in another iron butterfly with 2280 strikes. So this is showing the other butterfly coming in here. As you can see, it widens the position out a little bit, and it makes our position bigger. We now have about $10,000 in the position. Remember, we have a planned capital of $50,000. We do get up to that level at times when we have an extremely large up move in the marketplace, but if it's any kind of a normal move, then we generally stay well below that number. As you can see in this case, we have $10,000 in the position. So from here, if the asset price gets to 2320, we're going to add in another third up here at 2300, but that doesn't happen. So let's move forward here. So here on the 4th, the asset price starts pulling back, which is what we want. We would actually like this thing here probably to settle in this range and for us to make our money. And when the market behaves as it normally does, most of the time the market goes up for a little bit and then it kind of settles back a little bit, and then it'll go up for a little bit and settle back for a little bit. That's normal market behavior. The adjustment strategy on the trading strategy itself is meant to take advantage of that dynamic. So everything's going fine here. So if we get here to May 10th, things are going well. We're up about 41.69. Remember, we have a profit target of 15,000, which would be a fantastic return, by the way, if we returned it in this configuration, because we only have $10,000 in the position. So theoretically, we're up almost 50% right now of what we have in the position. But from a planned capital standpoint, it's still less than 10%. So let's move forward some more. So here on the 11th, you can see we are outside the tent. But depending on how far from expiration you are, that's not always a problem. So here, we're outside the tent, but we're still what we call negative delta. And what delta means is the estimated value change in the position if the asset price were to move $1. So in other words, if the price or the asset price were to go up $1, the delta is telling us that, at least from a model standpoint, the position profit and loss will lose $15. If it goes down $1, the position profit and loss, if everything else staying equal, should go up about $15. And that's what that means. We're still negative delta. We're outside the tent, but there is no problem here. So let's move forward. Then on the 12th here, we get a 69-point down move, which is huge in the Russell. It's a very, very big move for the Russell. And we were already outside the tent, but you can see we still don't really have an issue here. We are positive 14 delta, and that's not substantial. We're still look really good on the T+0 line here. But according to the strategy guidelines, we will make an adjustment here. Because we're positive delta and we're well outside the tent, what we're going to do is we're going to take off this butterfly we added at 2280. So you'll see that butterfly become removed. We now have approximately $4,000 in the position. We're up about 2179. Everything's going well. From here, we essentially don't do anything to the downside. We may end up taking a loss on this. If we do, it'll be a minor loss because, as I said, we only had $4,000 in the position and we're dealing with a profit target of $15,000. That makes the strategy very safe from a risk reward and total risk standpoint, which is one of the things I love about the strategy itself. If we go here and we move forward, market bounces back up again, which often happens, by the way, which is why we deal with the strategy in the way we deal with it. Generally, if you haven't noticed in the last 4, 5, 6 years, we get a big down move, that up move's coming back, and we just wait for it to happen. And hopefully it happens within the time we have left in the strategy. So this is where we are now. This is what we look like as of May 19th. Everything's going well. We're up about $3,400 on our capital in the trade, which again is less than $5,000. All right, so at this point you'll notice that we are, time has gone by. We're up about 10% of our planned capital. We actually have more than 100% of our capital at risk at this point. The position's looking really good, but it hasn't done as well as we'd like it to do. Normally at this point, we'd like to see us getting near our high profit target of $15,000, but that kind of didn't happen because we got kicked back in the position and we had to pull out of our upper butterfly, so it makes it a little bit harder to make money. This trade is going okay. It's not going what we would call extremely well, which would return us a 30% profit, but we're happy with it. At some point, as I get closer to expiration, the position starts to get to the point where it's where it becomes more sensitive to price movement is what I would call it. That being the case, we reduce our profit target to $5,000 when we get to 21 days to expiration. Right here, we're 23 days to expiration. We're not quite at the number. Would it make sense to actually pull out here and take your $5,100 profit? I'd say probably, but according to the rule set, we're not going to do that. So we're just going to move on. We get our 27 point up move the following day, so we're up only about 4,600 at this point. And then on Friday, we get a bit of a flat day, maybe a bit of a pullback, and the position is up almost about 58.80. It's 58.79, 99, so almost 58.80. That is over 10% of our planned capital, and it is 21 days to expiration. This is the date that we lower our profit target to our lower expectations because the trade isn't working as well as we'd like. In this case here, we're up over our 10% number and we're 21 days to expiration, so we would exit the trade. And in this case, our profits would be 58.39.99 after execution. And that gives us a return of approximately 11.7% if I'm doing the math in my head properly. Very nice return, and that is on our planned capital. And if you remember, our total capital in the trade for the duration of the campaign was under $10,000. So that's over a 50% return on the actual capital utilized in the strategy. And that is the bearish butterfly, this episode's winning trade. If you like what you see, I encourage you to come along to lockinyoursuccess.com. That's LOCKE-inyoursuccess.com, and discover how you too can follow along with this and many other great strategies as they unfold during our weekly options trading for income webinars. Also, go to thewinningtrade.com. That's thewinningtrade.com, where you can learn about upcoming winning trade presentations, as well as find out about our free trading performance podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see in the next winning trade, please post them in the comments below, and I'd be happy to answer your concerns for you. Thank you for joining me, and I'm looking forward to seeing you on the next winning trade.